Hi, this is Mary, and welcome to VITA Scholars Lesson 3. Today we're going to talk about interest and dividends, capital gains, what a consolidated brokerage statement looks like, and you're going to start a new return. Remember, when you're trying to find something in the software, use the form finder at the very top if you don't know where it's at. It's really simple. You just type in the form number W-2 or 1099 DIV, takes you right there. And remember, every time you enter a form, you will see it appear on the left-hand menu with a little paperclip by it. So if you want to go back and look at it again or add another one, you just click the little paperclip and it will take you right there for easy access. Let's get started. Today we're going to talk about interest and dividends. So what is interest? So pause for a moment and think about where you have heard the word interest in what sense. Interest can be both an income and it can be an expense for somebody. Interest is defined as money paid regularly at a particular rate for the use of money lent. So if you put money in your bank account, in a savings account, basically it doesn't just sit there in the actual bank you took it to. It gets put into the whole bank account. They use that money for investments and for other projects. Whenever you want it, you can take it out. But when you put your money in a savings account, you're allowing that bank to use your money. And so in turn, they pay you interest for the use of your money. It's the same as when you get a credit card or a loan. You're borrowing somebody's money to buy something. So you have to pay it back, but you have to pay it back with interest. So interest can be both an income and it can be an expense. For tax purposes, when we're doing interest, most of the time it is money that they earn. When we're talking about income, it's money that they earn, whether it be from a savings account, money market account, some checking accounts at a bank, a credit union. It could be from stocks. So that is interest. Banks do not have to give you an interest statement unless you make more than $10. Now, if you make $2 or 80 cents or $4, you're still legally obligated to report it because all income is taxable. In your book, Publication 4012, Section D is all about income. And on the very front of that section, it lists the different types of income there are. Now, just because somebody's sitting in front of you and they don't have an interest statement, you are still required to ask them, did you have interest in a checking or savings account, even if you don't have a form? The most common types of interest forms that we see in 1099 INT is for interest. Looks like what you see here on the screen. But they can look differently as well. These are just the common types. Again, make sure it's for the right tax year and it's for the right person before you put it on the return. If they don't have a 1099 INT because it's under $10, most of our clients, taxpayers, have smartphones and they bank on their phone. So all they have to do is open up the last statement, bank statement for them of the year. So whatever the December 31st bank statement falls on, and it will tell you, for example, here on Suncoast, you can see year to date summary and it'll say dividends. Dividends for Suncoast for any credit union are the same as interest from another bank. So they could have a statement or they could have they could have their bank statement, the last one of the year that they can look at, or they can have an INT statement. To enter interest in the computer, you don't need to have the actual form as long as you have the money. Dividends is very similar to interest. You're getting paid regularly, but when you have dividends, you're kind of part owner of whatever that money's coming from. So when you are a member of a credit union and they pay you what's called dividends instead of interest, the difference between a bank and a credit union is you kind of have part ownership of that credit union. So when they had their profits and they pay you for the use of your money, you get what's called dividends. When you have stocks and you receive dividends from your stocks, you're part owner of whatever company that stock belongs to, and they pay you with dividends. But when a credit union pays you with dividends, it goes on the tax form like interest. Even though they call it dividends, it's going to come on an interest statement because they want to confuse everybody. I'm kidding. These are the most common dividend forms you're going to see. Again, they can look different, but these are some of the most common ones. Notice on the one on the top, box 1 and box 1A and 1B are different. So box 1A shows you the total amount of dividends that they have received, total, from Mega Bank. Box 1B says qualified dividends are $765. That doesn't mean they got 1,256 and 765. This means that the total dividends they received are 1,256, of which $765 are going to get taxed at a lower rate. You don't have to do anything special, just make sure things end up in the right box on the computer. On this other one towards the bottom right, they receive $17,700 in dividends, and all of them are taxed. They're qualified at a lower rate. You just enter things in the right boxes. This is one from Primerica. This one has two different dividend statements on here. The first one is WA Managed Municipal, it looks like. It's what's in the red circle. The one down below is Invesco. They both have different tax numbers. Actually, look like the same tax number. But this is two different dividend statements on the same paper. Now, Primerica is kind of interesting. I've only run across this with one client. But if you have a Primerica statement that has multiple pages with 2 or 3 boxes on it, the first one usually will say grand total. If it's a grand total, you just enter the amount from that one box. You don't enter the other boxes because it's all combined there. So make sure you read the boxes very, very carefully with Primerica, so you're not double entering values and increasing their income when it should not be. Remember, you can pause this at any time. Here's a tip for you. When you go to enter interest or dividends into the computer system, you do not need to enter anything except the name of the company the money came from, who the payer is. So is it Suncoast, Bank of America, Primerica? Just the name, and then do the dollar amounts. You don't need to enter the tax number for the payer, their address. Look at the screen here. You only see stars where the black arrows are pointing next to the payer name. So whoever gave them the money, you put their name and then go enter the dollar amounts. You could enter everything, but why waste your time? It's not needed. It's not necessary, especially when you have a lot of them. Capital gains and losses. And remember, pause this at any time. For VITA, proceeds or income from the sales of stocks, mutual funds, or a personal residence are in scope, which means we're allowed to do it. Any other asset is out of scope for VITA. So if they sold rental property or they had land that they sold, that's an asset that's out of scope for us. Let me go back one page. A gain and a loss. Let's talk about the difference between that. Isn't it? And you probably know, but when you sell something, whatever you sell it for, if you subtract the price that you bought it for, if you sold it for more than you bought it for, you have a profit, or a gain, it's called. You gained money. If you sold it for less than when you bought it for, you have a loss. That's the difference between those two terms. You don't need to tell the computer they had a gain or a loss. The computer's going to figure that out automatically by the dollar amounts you enter. So let's just go over a little bit of terminology and things. The sales of stocks are reported on what's called a 1099-B, and B stands for brokerage. If you have the stock and you own it for less than a year, shorter than a year, that's called a short term. If you held it for more than 1 year, longer than a year, that's called a long-term transaction. The computer will figure that out because we have to put in when do they buy it and when do they sell it. And the system will automatically figure if it's a short term or long term. Again, shorter than a year or longer than a year. And any stock that is inherited, so somebody passes away and somebody inherits that stock, is considered long term, regardless of whether they bought it the day before they passed away. So any inherited stock is long term. You just click the box, the computer does the rest. On an actual tax return, when you're entering the transactions, they might have had some profits on some stocks and they might have had some losses on another. The most we can show as a net on the tax return is a negative $3,000 or a loss of $3,000. So if they lost more than $3,000 when you take everything that they did and you put everything together for their capital gains and losses, if their loss is more than 3,000, 3,000 will show up on the actual tax return this year, but all that extra losses gets carried forward or rolled over into next year to help them out next year. So, and it keeps rolling until it's all used up. So it's not like they lose that benefit. They can claim a loss this year that reduces their income, and that's going to reduce their taxes. And then anything left over goes to next year and the year after and the year after until either it's used up or they pass away. Again, the computer will do all that. So here again, how we figure gain or loss, the computer does this for you. You're going to enter the sale price, what they sold it for. Another word for that is proceeds. You're also going to enter the basis or the cost, and the computer's going to figure out whether they made money or lost money. The other things we have to enter is when did they buy it and when did they sell it. That way it can figure out whether it's short term or long term. And the reason why we need to know whether it's short term or long term is long terms get taxed less than short term. Short term transactions get taxed at a little bit higher rate. Long term get taxed at a little bit lower rate. Very few times, I think only once in my 15 years have I seen anybody have taxes withheld on a capital gains statement. But there is a box for that. If you see that, you're going to enter it. And then there's what's called the wash sale. You don't see this often, but if there is a wash sale, it'll be on the form and it will have a code W next to it, and you just type that in as well. And the other thing you need is a description. What is the type of stock, the name of the stock? So is it IBM? Is it McDonald's? Is it, I don't know, TikTok? What's the name of that stock? So again, the basis is the cost, what they bought it for. Now, usually this is on the 1099-B. It should be there, but occasionally it's not there. And the reasons why it may not be there is if one reason might be that they bought the stock with one company, one broker company, and then that company sold to another and maybe sold to another. And so the information about the cost got lost somewhere along the way. If you ever have a client come in with a brokerage statement and the cost is not showing, it's very important that they research and find out what that cost was. Because if not, we have to enter zero. And then whatever they sold it, if they sold it for $5,000 and we don't put a cost in there, the IRS is going to expect tax on $5,000. So it's up to the client to get that information. Sometimes I will help them out if I know when they bought it, and it'll say usually on that form when they bought it, but sometimes it doesn't. So if they know when they bought it, they or you can contact the local library reference department and you can look it up. There's also a couple websites that you can look it up if you know the day they bought it and the name of the stock. Sometimes they can go to the records. Sometimes they can even just call their brokerage company and get that information. But if it's just a few dollars, I wouldn't worry about it. $100 is not going to generate a lot of tax. But when we're talking, I had one lady, she had $120,000 in sales and no cost was reported. And of course, the IRS sent her a letter because she didn't file her taxes. And they're like, where's the tax on this $120,000? And so they sent her a huge, nasty bill. So she did the research, she got the information, and she actually lost money. And so they ended up owing her money when she filed her taxes. But IRS doesn't know the cost if it's not reported. So we need that cost. Again, but if it's really small amounts, I'm not going to kill myself for it because it sometimes has no effect. The different types of statements and tax forms that you might see are 1099-NT, which stands for interest, 1099-DIV, which is for dividends, 1099-B, which is for brokerage, that's your stocks. The forms can come in the mail one by one, all separate. Sometimes, though, they come together in a big packet if they're all from the same company and it's a multiple page packet. And usually, when a tax preparer like yourself sees this, they tend to panic because they have all these pages and all these numbers. But if you just take a deep breath and staple it and look at it in order and go from front to back, it's pretty easy. And I will show you. And sometimes they can have consolidated statements from more than one company. So I always staple things together first. When I'm flipping the pages, nothing gets out of order and I don't mix anything up. I want to show you a consolidated statement, and you will not be doing these by yourself for the first time. Okay, you'll be working with somebody. If somebody brings one in, then you just say, "Excuse me," and you get somebody with experience. But I just want to show you that these are not hard to do. Um, the practice scenario you're going to work on today is very, very simple. This is a step above that. But if you do get a consolidated statement, don't panic. This is what one looks like. This is actually like an 85-page document, but you don't enter everything on those 85 pages. It's pretty simple. What you see here on the top left is a dividend statement, 1099 DIV for dividend. And you just type in the name, which is Wall Street Concepts, and then you enter the numbers that are there. On number 2 on the right, you have a miscellaneous income form, 1099 MISC for miscellaneous. I think I've seen maybe one of these on a consolidated statement that actually had a value. Again, you just enter the information, type in the numbers, and it's done. Down at the bottom, this is a summary of all the stocks and that they sold. All the short term and all the long term, they have the totals there. This is a summary of what's coming on the pages next. On page 2, you will see the interest, the 1099 INT. You'll enter that information. You might have a 1099 OID, which is another form of interest. I think I've seen one of these in 15 years as well. It's not something you run across a lot. Excuse me. And then after that, you're going to have pages and pages, possibly, maybe not a lot, of the stocks and dividend transactions. And it'll list every transaction they have, but you don't type them all in. If you have a 1099-B, you're going to read it. The very top where that yellow arrow is pointing, it says short-term transaction. And it will tell you whether the cost was reported to the IRS or not. You don't have to enter all these lines. No, 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 no. You just need these values over here on the left. So when you're looking at this page on the right, there's grand totals at the bottom, and it will say short-term transactions reported to the IRS, here's the cost, and then here's what they sold it for. So you don't enter every line, you just enter the totals for the short term that were reported to the IRS. And maybe there's a section that says short term not reported, and then you enter those totals. It's not hard, it's very simple. I do want to show you what happens when you enter all that stuff. Every type of transaction for stocks that you enter, and there's actually 4. There's short term where the cost was reported to the IRS, and then there's short terms where the cost was not reported to the IRS, but it's on your paperwork. There's long term where the cost is reported and long term where it's not reported. Regardless, any transaction you do, the first thing you're going to see on your computer screen is a summary. So that's pretty cool. You can kind of see what you did. From there, it carries over to what's called the 8949. So once you enter stocks, your tax return is all of a sudden going to have lots of pages print out. So an 8949 is going to print for each of those 4 categories I just mentioned if they were used. And then all the short-term 8949s, if there's 2 of them or 1, they end up on the Schedule D at the top. And any long terms get combined and end up on the Schedule D at the bottom. and then the short term and long term combined together for a grand total on the actual 1040. I'm just explaining the flow, but just by entering those transactions on the computer for capital gains, it can generate up to, let's see, that would be 5 schedules before it even goes to the actual tax return. So you'll see a lot of extra pages. Don't panic. It's just a summary, it's just a review. It just combines it all together and just moves through the return. After you do enter any capital gains in the system and you're looking at the income menu, you'll see little printer icons appear. If you want to see what that Schedule D looks like, you just click the little printer. All interest and dividends go on a Schedule B. Not that you have to memorize this, but once you enter one of those forms, a little printer icon will come up as well. You can click that and see, what does that Schedule B look like? And if they have more than $3,000 in losses that are going to carry forward, there will even be a worksheet that prints so that we circle that carry forward loss. And please, please, please make sure you take this to whoever does your taxes next year so they know to enter this for you. Highlight it, circle it. But your reviewer will help you with that, will show you all that. Be there when they explain that return to the taxpayer for the first time. But they're very, very simple to enter. And once you enter one, you'll be like, oh, I got this. It's a breeze. It just looks intimidating. So a few tips before we talk about the return is use your book. Review the intake form carefully. This is for every return you do. Make notes on the intake form so you don't forget to complete something later. And then your quality reviewer knows what to watch for. Highlight the form numbers, especially on a consolidated statement, because you can have all those different forms just in one set. Also highlight any values and codes that you need to enter, especially on those 1099Rs. Use your book. Okay, so we're going to start on the Stephanie Winters scenario today. We're not going to talk about the whole thing. There's just way too much going on for this scenario to do it all in one session. So in your book, 6744, page 92, please pause this and get your test book out and open to 92. Okay, so we're just going to touch on these few points today. We're going to skip a good portion of it in the middle and talk about that next time. So the results I'm going to show you today only have to do with these bulleted points. So Stephanie's 26, she's single, she has no dependents. She has investment income. She is paying on her student loan from 2019 when she completed her undergraduate degree. She is working towards her Juris Doctorate degree to start a new career as a lawyer. So she's in school for graduate studies, basically. She took a few college courses this year at an accredited college. She took out an early distribution of $5,000 from her IRA in April. She used $2,400 of the IRA distribution to pay her educational expenses for the current year. So she is not 59 and a half yet. We talked about this last time. She's not 59 and a half, and she's taking money out of a retirement account. You see her Social Security card here. Remember, when you're entering the Social Security number, use 1, 2, 3, 4 for those X's. Go ahead and pause this while you look at her intake form, and then unpause it when you're ready to come back and talk about her tax forms themselves. Okay. This is her 1099-R, and this tells you on the top right, this is from a pension, annuity, some kind of retirement account. Now again, always make sure it's for the right year and the right person. You're going to highlight where you have information that you're going to enter. So you're going to highlight box 1, box 2A, 2B, and not to be. So box 1, 2A, 2B, box 4, box 7, and don't forget the check mark. Now, you have a code here in box 7. Don't forget to look that up in your book. You need to look it up and follow the instructions for that. She also has a consolidated statement. this is in your book as well. You're going to highlight the form numbers. In this case, at the very top, we have a 1099 DIV for dividends. And you're going to highlight the numbers that you see for that form. So highlight those now. She has a miscellaneous form, but it's all zeros, so we don't have to enter that one. The next form she has is a 1099 INT, which stands for interest, and highlight that as well, those dollar amounts there. So consolidate just means to put things together. So this is putting different forms together. Now at the very bottom of that page, you see a summary. This is just showing you what is to come. This is not a tax form at the bottom. If you look at the next page, it is showing you where that $5,000 came from. $5,100 came from. You actually have a 1099-B here and a 1099-B on the bottom. Now, if we read these, and I have highlighted here, this is very important information. This is what you need to know. The first one says it's a short-term transaction for which the basis, the cost, in other words, is reported to the IRS. When you enter this in the software, there's going to be a box, a drop-down box, and you have to say, was the cost reported to the IRS or was the cost not reported to the IRS? And you just have to know which one to click, and it tells you right there on the form. You also need to know when they bought it and when they sold it, which I put those red boxes around it for you, but I don't do that on the actual form for the client. What they sold it for, proceeds, is another word for sale price, what you got from that transaction. And basis or cost. So she bought this for $1,750. She sold it for $2,000. She sold it for more than she bought it. So we have a gain. She made money. Now that $250 on the end, you do not enter that in the computer. The computer is going to figure that out for you. Don't enter the $250. You're entering the day they bought it, the day they sold it, what they bought it for, what they sold it for. And it's going to ask you for a description. So the name of this stock is Nebraska. So that's all you need. The one down below, it's a long-term transaction and the basis or cost is not reported to the IRS. So there's a drop down, you're going to click not reported. Again, I see when she bought it, I see when she sold it. I see she bought it for $4,000, that was her cost. She sold it for only $3,100, so she lost money. And that's why you see the 900 in those parentheses. She lost $900. You do not enter the loss of 900. The computer will figure that out for you. And then the name of this stock is Iowa. And that's all you have to enter. When you get to the form to enter this, it is stocks, capital gains. There's a menu of like 4 different options. Put it in the one on the very top. When you get to that menu, it's the very first one you're going to be entering these in. She does have student loan interest, so I need you to look in your book to see, does she qualify to claim that student loan interest? What can you claim? What questions should we ask her if she was sitting in front of us in real life? Now, of course, the answers were given to us. All the information we need are in the interview notes. But if this person is not sitting in front of you, we have to learn how to get that information out of them. So what are some questions that we could ask? So in section E, I'll help you as far as that goes. But remember, you have your index and table of contents. Whenever you have something, you should look it up to say, do they qualify for it? Do they not? What do I need to know in order to determine if they do? And the other thing that is on this return is education credits. So based off the information that you have, and you're going to have her 1098T form in there. I didn't show you all the forms, but you're going to have the 1098T. Looking at that, based off the information on the interview notes, which credit is she going to qualify for? Now, and why, I want you to understand why. Before you do the return, figure out what credit it is. And then when you enter it in the system, remember the system's going to tell you which one they qualify for as long as you answer the questions right. So see if you got it right. But look at that carefully. We are not doing anything related to her self-employment today. We're going to talk about that next time. So do not touch or do not enter the 1099 NEC that's in your packet. Do not enter the 1099K or anything related to her self-employment. Based off of the information that you have from the interview notes and the forms, is there anything else you're going to want to ask her before you get started? Think about that, and then go ahead and work on that return. This is the results you should have if you only do what I had just showed you and talked about. So do not do anything with the self-employment, and this is the results you should get. Next time, we're going to talk about self-employment income, and we will work on finishing the return. But this is the results. This is not a completed return. This is just part one. Thank you very much. And if you have questions, you can email me. You can also visit me on Zoom on Saturday nights from 7 to 9 p.m. The link is on the website, vitaresources.net. First half of that tax return, go ahead and go to the website, vitaresources.net/ethics, and view the Code of Conduct training. There's actually two trainings there. One is Code of Conduct and one is Intake Interview. At least do the Code of Conduct one, which I call Ethics Training. View that, answer the 10 questions in your test book that are on page 1014. I'm sorry, on page 14, that's where they start. There's 10 questions, common sense stuff. Play in the practice lab. The more you're in there, moving around, figuring out how to do stuff, getting to the end, marking it ready for review, paper file and all that stuff, or e-file, you're going to be a lot more comfortable and confident using it, especially when you're in front of a client for the first time. So just practice. You can do the returns over and over again if you want. Just change the social security number or go in there and change something that's on there. What happens if you increase the income by $5, $10, $15,000 or decrease it? And then, of course, I love to play what happens if I win the lottery. What am I going to owe? I mean, you can't hurt anything in Practice Lab. So this is your chance to play and have fun with it. I do Zoom drop-in sessions every Saturday from 7 to 9 p.m. until tax season starts. The link is on the website as well. You can also email me if you have any questions. I'm here to help. Have fun.